Good morning. This is live daily market outlook from the brokers for Tuesday, 2nd of April 2013. Beginning of the proper trading after, long Easter weekend has seen increased action in the markets following a quiet period since last Friday's markets were shut due to Good Friday, with yesterday's release of US factory data that came at a lower than expected, denting the US dollar's stance as the greenback falls versus the majors, and the top performer was the US dollar Japanese yen that posted fresh 1 month low on yesterday's fall down to 92.56. The yen, as said, is now improving. Currently, as 1 month high against the US dollar was posted yesterday, and on the softer than expected US data. From the other side, the single currency remains well supported for now, following a weaker dollar as it extended its gains up to 128.75, where technical strong barrier 200 days moving average so far limited gains. Cable also remains in the positive, maintains a positive stance following further extension of the recovery from the recent low posted on 27th of March at 150.91, with the fresh extension higher seen during the Asian session to 152.56, keeping the more focus towards the upside. Basically, the previous multi-year range floor at 152.30 and 152.60 has now been cracked. However, the pair stays short below its recent high at 152.59, and we need to see the break above this level in order to resume recovery. That looks quite likely due with some corrective action seen on the overbought hourlies, but larger picture outlook still maintains positive tone. Said the dollar yen is at its lows, currently correcting. Dollar Swiss came under increased pressure as the weaker greenback pushed the pair's price as low as 94.42, but overall picture is still showing the range trade. If we take a look at the 4-hour chart, then we can see that the pair is entrenched within 90 and around 93.50 and 95.65 range, with the price currently moving somewhere at the midpoint of the current range. The crude oil remains steady under 97.00, with the support at 96.00 so far, holding the downside and being the price consolidating recent gains that reached so far 97.68 high. Yellow metal showed slight improvement yesterday due to the weaker dollar ticking above 1600, the psychological barrier, and so far holding above this level, with the brief dip this morning down to 1598. Still having a sort of positive near-term tone, but more action higher above, at least break above at least 1608 is required to improve the near-term structure, as basically the current near-term price action is entrenched within 1590 and 1608 limits, and the break of either side will give us some more clear picture of the near-term direction. As said, pressured the US dollar due to yesterday's weak US data may give some positive tone to the yellow metals near-term price action, but still break above initial barrier at 1608 on the upside, or loss of 1590 as a range floor on the downside will direct the price in the near term. From today's calendar, that is quite full, as we are back to business, and the indicators, a lot of releases are seen for today. The top release during the night was Central Bank of Australia release of the interest rates that came as expected. They stayed pat at 3%, but basically affecting the Aussie dollar that is now in the positive tone and rallying towards the recent peak at 104.96. The other releases from Australia, commodity prices dipped further to minus 7.5% compared to minus 7.2% in the previous release. Spanish unemployment change came in disappointing minus 5,000 compared to the 30.2 thousand forecasted new jobs. Okay, that's again much lower than the February's release that showed adding out 59.4 thousand new jobs. The Spanish manufacturing PMI is out. We still don't have the update at this moment. It was a few minutes ago. 44.2 is the release, lower than expected 46.2, and the lower than February's 46.8. Series of PMI data are also due to be released today from Europe. Following is the Swiss PMI that is due at 7:30 p.m. 50.5 forecast compared to 50.8 release of month of February. The Italian manufacturing PMI is due 15 minutes later at 7:45. GMT 45.4 versus 45.8 previous release, and the Eurozone's final manufacturing PMI for March is due at 8 o'clock. GMT 46.6 forecast unchanged from the release of month of February. As we can see, the most of European PMI figures are still well below the 50 level that divides contraction from growth, and showing that quite negative outlook is seen in the near term for the Eurozone manufacturing overall. Further releases come from UK. Again, the manufacturing PMI for March due at 8:30 GMT. 48.9 forecast improvement according to the forecast compared to from the February's release of 47.9. UK data at the same time, mortgage approvals for February are showing 54,000 compared to 54.7 in the month of January. Eurozone unemployment rate for February is due at 9 o'clock GMT, and is expected to tick higher to 12% compared to January's 11.9%, showing that showing no signs of recovery of the overall Eurozone economy for now. That might be another pressuring element for the further weakness of the overall Eurozone economy. And finally, from U.S., economic optimism for February is expected, according to the forecast, to improve. 46.9 is the forecast versus the January release at 42.2, and at the same time, February's factory orders monthly release is forecasted well above previous release that was at -2%. 3.1% is today's consensus, and this is all from the fundamental part. We're going to take a look now at technicals and see the expectations for the major currencies and commodities in the coming hours of today's trading. As said, the action is back into the markets, and the instruments are accelerating following a quiet trading period during the long Easter weekend. As said, the euro-dollar remains so far supported after jumping off of 127.50. We're talking about double bottom now on a near-term basis. The price cleared the initial 128.40 barrier and extended so far to 128.75, where exactly 200 days moving average stands, and so far limits gains. We need to see the break above this level, and again another significant which is psychological 129.00 level, also 50% retracement of the latest downleg from 130.47 to 127.50 to confirm the recovery and complete this phase that commenced from 128.88 high of 26th of March. Break of 129.00 is to open way for a stronger recovery, though the overall bearish tone is still in play. Basically, break above 129 is required to improve the 4-hour structure that is showing improving. That shows improvement currently, as indicators are attempting to break above their midlines, and most of the all indicators basically are positively configured now, and being supportive for a possible fresh extension higher, as the upside we set so far was limited by 200 days daily 200 days moving average, and the 4-hour 55 days exponential moving average at 128.75. This is quite a strong barrier, and we need to see the break above this and 129.00 in order to resume recovery and delay immediate bears. However, as said, negative tone that dominates on both lower and larger time frames is still keeping the downside favored, as the single currency lost approximately 7% since its at the beginning, since the beginning of the year, when on 2nd of when the pair reached fresh high at beginning of February, I would say, at 137.10. So 7% loss. That so far retraced over 50% of the initial rally from 120.42 July 2012 low to 137.10 beginning of February yearly peak, and seeing the downside still more favored at this point, with the current bouncing seen just as corrective. As long as we are holding below 130.50, that is seen as a break point for some stronger recovery action. British pound also remains well supported against the US dollar following yesterday's weakness of the greenback. The pair extended gains to 152.56, so far still holding short under the recent peak at 152.59, but overall positive structure sees potential for possible extension above. That will signal resumption of the larger recovery rally from 148.30 low of 12th of February 2013. Corrective pullback on overextended hourly so far being contained at above 152. That is seen as initial support. 152.15, 152.00 is seen as the initial support on the downside, and it's also reinforced by 55 days exponential moving average hourly one at 152.04, seen as ideal level to contain dips ahead of more significant 158.75 higher platform of yesterday, as well as 50% retracement of the entire recovery rally from 150.91 to 152.56. Any break below 151.75 will increase the downside risk and bring the bears back in play. Otherwise, we still have focus at the upside break above 152.59, and basically this is the, as I said, the previous range, multi-year range lower at 152.30, 152.60 break of which is required to open way for some more significant recovery towards the upside. The 153.00, 153.20 will be seen as the next upside targets in case of a clear break of 152.59. Dollar yen, as said, remains under pressure. Fresh 1 month low posted at 92.56 on extension through the previous low at 93.52, as well as losing a psychological 93.00. Support, this also marks between 61.8 and 76.4 retracement of the recovery rally from 90.85 to 96.70, with the downside being favored at this point, as negative tone dominates on both 1 and 4 hour charts, though the hourlies are quite extended at this point, and the RSI is already emerging out of the oversold territory. That could be initial signal for some stronger recovery action. And 92.95 since so far we have the initial resistance at 93.00, and then more significant is the previous low at 93.52. That is basically seen as a limit for the any stronger bounce higher at this point, and the retracement of the latest down leg from 94.36 down to 92.56 shows 93.25, 38.2%, and more significant is, as I said, a 93.50 zone, where we also have the 50% retracement, as well as descending 55 days exponential moving average currently at 93.57. So break above 93.50 with the sideline immediate bears in favor of some stronger corrective action, though the overall picture is still quite bearish, and the sees more focused towards the downside as loss of 92.15, 92.00 is expected to open downside supports at 91.50 and the 91.00. Dollar Swiss, as I mentioned at the beginning, is the best shown on the 4-hour chart within the range that is defined on the downside by 93.50, on the upside 95.65, following the last week's failure to regain the previous high. Upside rejection at 95.51 has triggered the fresh extension lower. Basically, the price is currently moving approximately around the midpoint of the current range, and showing no direction at this point. Weaker 4-hour indicators for now still see possibility of further extension lower, while the negative tone prevails on the hourly chart, and sees again the downside more favored for now. We may see extension down towards lows at approximately 94.15, 94.00, while anything below 94 would bring at risk the recent range floor levels at 93.77, and more significant is 93.51, loss of which is said to bring more bears into play. Conversely, break above a previous high at psychological 95.00 and the previous high at 95.25 may again bring 95.50 and 95.65 levels into play, as a larger picture daily structure is still maintaining a bullish tone as long as the price holds above 200 days moving pardon, average that is currently at 94.18. As said, break above 95.50, 95.65 is set to resume the larger uptrend from 90.20 and open and 96.00 is the next upside target. And from the currencies, the last one is the Aussie dollar against US dollar that remains well supported for now, following a bounce of 103.85 where the temporary ground was found, and the pair rallying to retrace nearly over 80% of the entire fall from 104.96 to 103.85 on the yesterday's spike to 104.78. A corrective pullback is seen on the overbought hourlies, and still sees a possibility of further extension lower where we have good support levels. 38.2% is approximately at 104.40. 50% at 104.30 zone, also close to the previous highs, and ideally dips should be contained somewhere at around at or above 104.20, 104.30, where we also have the bullish 20-55 days moving averages break. Otherwise, loss of 104.20 will again shift focus towards the downside, and risk retest of 104 and 103.85. Ideal reversal is set seen somewhere above 104.20, 30. That will keep focus at the upside, as 4-hour indicators are now attempting to break above their midlines, still lacking momentum for this. If we don't see regain of 104 and 96, then increased downside risk will be seen again, though the current structure is still having a positive tone, as the price is well above both 20 and 55 days exponential moving averages, but again failure to regain 104.96, 105 may risk further easing. Daily structure for Aussie dollar remains firmly bullish, and sees the upside favored for now, as the pair found support just above 200 days moving average that could indicate further extension of the recovery rally from 101.14 for a final push through 105.00 towards our upside targets. 105 interim resistance is 105.77, and the key upside barrier is at 105.97, peak of January 10th of January 2013. we have mistake. Instead of crude oil, we pressed coffee. The crude oil remains well supported for now, as we can see on the Ichimoku studies daily structure shows a break above daily Ichimoku cloud top somewhere at 96 zone that now acts as a good support. Tenkan Sen line is above the Kijun Sen line and pointing higher. That is another positive element, keeping focus on the upside in the recent highs at 98.63, the peak of 13th of February 2013, and basically looking for a full retracement of the corrective fall from 98.63 down to 89.35. Positive tone dominates on the 4-hour and the daily chart, keeping the upside focused, while a more sideways neutral tone seen on the hourly as the oil price is currently consolidating recent gains with, as I said at the beginning, 96 zone, recent low posted yesterday, seen as initial support, and ideally seen holding the downside for now. However, further extension lower is not ruled out, as 4-hour indicators are now in descending mode, correcting the current pullback. Basically, the main risk will be seen on the loss of 96.00. That will confirm the failure swing and allow for some deeper reversal, where we'll be looking for 95.25, 55 days exponential moving average, and then approximately 95 zone that marks 38.2%. Fibonacci retracement of the latest uplift from 91.82 to 90. I do apologize, it's not very correct. To 97.68. Now we have changed the levels. 95.44 is 38.2%, and 95.26 is the 55 days moving average. While break below 95 psychological support and the 94.75 50% retracement would delay immediate bulls in favor of some stronger corrective action. If we take a look at the larger picture, retracement from 89.35 base, then 94.50 previous high and 38.2% retracement should in any case hold any stronger dips in order to keep the bullish structure in play. And if we compare it to the previous corrective action, this will be approximately equivalent of the depth of the pullback before the price bulls reassert for final push towards 98.63 and possible extension higher, where we will be looking for test of $100 per barrel, our short-term upside target. And finally, we have the gold that is still entrenched within the range. It's best shown on the 4-hour chart, where the downside is limited at 1590 and the upside at 1608. Rather, the directionless trading, some more positive tone was seen yesterday on a brief break above 1600 psychological barrier. 1603 seen so far, but nothing significant happened. As you can see, the price is still hovering around both 50 and 20 and 55 days moving averages, showing no significant movements. Slightly negative tone seen on the 4-hour chart, as most of the indicators are pointing lower, but basically break either below 1590 as a range floor, or also marking 50% retracement of the latest uplift from 1561 to 1616, or break above 1608 initial resistance, and the range top will give us some more hints about near-term direction of the yellow metal. A larger picture is still showing the downside vulnerable, as the gold price failed to regain its initial resistance at 1620. That marks the 50% Fibonacci retracement of the downleg from 1684 to 1554, and it's also slightly above 76.4% Fibonacci expansion of the latest upleg from 1564. So still we have congestion under 1620, though the price holds above ascending bull trend line drawn of 1554. Narrowing range and triangular consolidation is seen at this point, and basically break for either side will give us more direction at this point. But as said, a slightly more positive tone seen on the daily chart might see the potential extension towards 1616 and 1620. This is seen as a break point in order to resume recovery from 1554. Otherwise, break below the trend line support at 1593 currently, and the 1590 range floor would risk further reversal and keep the downside vulnerable. And that will be all for today, Tuesday, 2nd of April 2013. We are now in the new month, and basically we are in the second quarter of the year. We'll be watching how the instruments will be performing in this. As I said, euro lost approximately 7% in the recent fall. We believe that some more positive tone will be seen in the second quarter. Keep an eye on the markets, on the calendar, as we have a number of releases for today, and expect to see you back tomorrow morning at the same time at 7 o'clock GMT, 10 o'clock local Cyprus time. Wish you a nice day. Good luck.